the S&P 500 just had its fourth straight positive week and is at the highest level since August of 2020, and the NASDAQ far above it. I mean, the NASDAQ has done phenomenal in 2023. What can we expect from the week ahead? What are the major catalysts, and what should you know? Because things are going to get very volatile very quickly. Ladies and gentlemen, let's dive into all of this information. We will give you a recap of the last week with AMC as well as GME and where the data currently sits with AMC stock. So, ladies and gentlemen, hit that like button and subscribe to the channel and source your comments, questions, or concerns down below in the comment section. So, number one, S&P 500, highest level since August of 2022. You're really at a breakout moment. You're at 430 on the SPY. This is major resistance. If you get rejected from this level based off of the catalyst that we're getting this week, if they are taken negatively, well, stocks are going to fall quite a bit. Now, a lot of stocks have already fallen quite a bit, and most of your stocks in 2023 have not done well. If you look at the S&P 500 on an equal weight basis, it's virtually flat for 2023, meaning the average stock in the S&P 500 is about flat. Not your big tech. Your big tech is up massively. And that creates a problem. As Jim Cramer says, which you can never believe what he says, but you still gotta talk about it because it's Cramer. He says, don't be complacent before Fed meeting. I do not trust a benign market like this one. And that's exactly it. I mean, I kind of resonate with Cramer on this one for once. I think a lot of you guys should. Because what's the overall psychology that people like to say, right? Or the kind of way people like to think about the markets. People will tell you when things are super negative, when investors and analysts are super negative, it's usually the time to be buying. Warren Buffett said it 40 years ago, 30 years ago. He says, basically buy when people are fearful, sell when people are greedy. That's literally it. Be greedy when others are fearful and be fearful when others are greedy. How come the markets are ripping and everyone is talking about the markets are going to continue to rip? Like there's never going to be downside anymore. That's what, if you watch CNBC, that's basically what you're going to get from CNBC. It's not really the most optical market. Stocks are most certainly priced for perfection. And then to the contrary, when stocks are, crashing and burning, you should be buying. People tell you to don't buy. So when things get overextended on either side, that's really when you want to be a buyer. And we'll see what happens this week. But what I do know is the catalyst that we have. The first catalyst is going to be on Tuesday. And that is going to be your inflation report. Now, the inflation report is really going to dictate what the Fed does. Now, inflation rate headline month over month for May, you're expecting that to come in at 0.3%. That's the forecast. Consensus is 0.2%. The previous month was 0.4%. So this would be a welcome decline month over month. Core inflation rate year over year, you're expecting that at 5.4%. Last month's reading was 5.5%. So again, a deceleration. Headline inflation rate year over year, expecting that at 4.1%. Last month was 4.9%, so a much steeper decline on the headline inflation rate. And you're expecting the core inflation rate, this is strange, to come in at 0.4%. Last month's reading was also 0.4%. So you're really not expecting too much change on core month over month, but you're expecting core year over year, headline inflation year over year, and headline inflation month over month to basically start falling quite a lot. Now, if that happens, if inflation does fall a lot, well, the Fed's not going to raise rates. If inflation is even matching some of these, exceeding these expectations just a little bit, Fed's going to raise rates. It's going to be a negative thing for the markets. Now, Tuesday, That's when inflation data is going to come out. Wednesday, the next day later, is the Fed meeting. So it's going to be like, boom, boom. We're going to know like 12 hours. That's all the time we're going to have between, are we going to get a rate hike? Are we going to get a pause? And then boom, the Fed's going to do it. You really don't have a lot of time to digest that information. And that's obviously, as always, going to come in at 2 p.m. Eastern time. You're going to get the Fed. You're going to get the press conference 30 minutes after that at 2:30 p.m. And then on Thursday, it's going to be another big catalyst with retail sales month over month for May. You're expecting negative 0.1%. Last month's reading was positive 0.4%. So you're expecting things to, get a little bit worse there, and quite a bit worse month over month. And then you get initial jobless claims. Last week, this came in 261,000. You're expecting 275,000 this week. So you're expecting a sharp acceleration again in the initial jobless claims, although that tends to be very volatile. And I don't think that'll give the markets a huge impact. You're also expecting manufacturing production month over month, industrial production month over month, Philly Fed new orders, Philly Fed business employment, Philly Fed business conditions, import prices, export prices, retail sales, excluding gas and autos month over month, as well as many other, regional data points that come out. And these data points are important as well. But I think at this point, the Fed and inflation, those are probably going to be the things that really dominate this market. Now, if we look at what the markets are currently pricing in for the Fed for next Wednesday, for June 14th, 70.1% chance of a pause, 30% chance of a rate hike. If inflation is hot, you're going to shoot over 50%. And the Fed's going to do whatever the markets are pricing in. Whatever is over 50% is what the Fed historically has always done. So the Fed does listen to the markets. And that's why the Fed comes out and they try to talk the markets in one direction or the other. It's no coincidence that a bunch of Fed members will come out on a specific day and they'll say the same thing. They're trying to move these probabilities around because they don't want to do something that the markets are not pricing in. They don't want to create a problem when they don't have to. Vice versa, they don't want to create optimism when they necessarily don't want that as well. And that's kind of what they've inherently done in 2023. Now, what's interesting and weird is July 26, 2023, so the next meeting after June, markets are expecting a rate hike by 52.8% probability, a 30% chance of a continued pause, and a 17.1% chance that the Fed raises in June and then they raise again in July. So these probabilities are all over the place. And then the markets are firmly pricing in at this point the Fed to have raised rates in July, to hold rates at 5.25% to 5.5% in September, and then to cut rates down to 5 to 5.25% by November 1st. So you're expecting a pause, a rate hike, a pause, a rate cut. That's what you're expecting right now. There is no trend to that. So it's typically not what the Fed wants to do. So I think you're going to get a lot of movement in pricing in of future Fed policy off of this next upcoming week. And considering where stocks are right now and how much they've really rallied recently, I think that puts the markets in a very precarious situation. Now, not to mention with stocks such as AMC, June 16th is a quad witching week. So you're going to have futures, stock options, and I don't even remember what the fourth one is. Doesn't matter. You don't trade them as retail investors all too often. But you're going to have four major asset classes that are going to be expiring. Futures, stock futures, options. Let me know which one I'm missing down below in the comment section. It's probably gonna come to me by the end of this video, but you're gonna have all of them expiring this week. Typically, they don't tend to be the biggest driving weeks. Usually when you get quad witching weeks, it's actually not very volatile. But this one has the potential to be very volatile considering it happens to be inflation week as well as the week of the Fed and retail sales and all the other data points that we just previously talked about. AMC stock is also going to have a very big week with a lot of money expiring in these options. Now, calls in the money sits at 14,000, calls out the money at 548,000, puts in the money at 342,000, and puts out the money at 501,000. Gonna be a very big week for AMC options. So we'll see if AMC does move up or down big. I mean, you're going to get a lot of hedging and de-hedging by market makers. Could fuel a gamma squeeze to the upside, although I think most of that downside has already been factored in. I mean, when you look at the ratios here, right? Puts in the money, 341,000. Puts out the money, 501,000. You actually have more calls out the money than puts out the money. 548,000 calls out the money. But look at that, 14,000 calls in the money compared to 341,000 puts in the money. You're massively disconnected here. This just shows, I mean, the stock's been falling quite a bit recently, obviously. And that's what's going on there. Now, if we do go ahead and take a look at the Ortex data as well with AMC, things have really never looked better for a potential short squeeze as far as the data is concerned. Short score of 93, 528 million in short positions, 21.86% estimated short interest or free float. Days to cover, 7.87, extremely bullish, highest it's been in over 18 months. It's actually 241.41% higher than it was 18 months ago. Insanely bullish. You also have 100% utilization, and it looks like the cost to borrow fees are also spiking still, even after GME earnings. And I think that is very interesting. Not to mention Intera Capital, like we said in the last video, is dumping Ape. Maybe there's some good news to come. Hey, we'll see. Cost to borrow average of 145.37%. Cost to borrow max 311%. Cost to borrow minimum of 50.13%. Interactive Brokers has 0 shares available of AMC to be lent out. Last we knew, they were offering AMC shares at a almost 45% cost to borrow fee. So cost to borrow fees are very high. Intera Capital dumping shares of AMC. Lots of catalysts that are going to give the markets huge volatility. All in all, considering AMC stock has fallen over 20% recently, looks like a pretty good opportunity. Hey, but we'll see. Let me know what you guys think about this week down below in the comment section. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day and weekends, and I will see you in the next one.